Sam, it's great to see you today. Set the scene for me a little bit when you're looking at how to balance the geopolitical movement, which the markets appear to be shrugging off, and what comes down the pike in a couple of days at Jackson Hole.
Hey, Contessa. Well, as we pivot from the dramatic to the mundane, I guess investors are now thinking, well, what's going to come out of Jackson Hole? Is the chair likely to say that they are still data dependent? And if that is the case, well, then we're looking at the possibility of a slowing employment picture while at the same time maintaining a fairly sticky inflation environment. Our expectation is the year-on-year core PCE will remain at or above 3% through this year. And so that's a concern that they will have to deal with. But we're going to be listening quite closely to see whether Fed Chair Powell will be sort of setting us up for a rate cut in September.
You know, it's interesting. I had a conversation with David Zervos of Jefferies a while back, and I asked him if the economy is going so well, if we've seen unemployment numbers that are good and consumer sentiment seems reasonable, then why would the Fed cut? Because it's working where they are now. And he said one thing, housing. We're seeing today that home builder sentiment has dipped back down to the lowest level that we've seen since 2022. What's your view on how much the Fed needs to consider housing in their overall analysis?
Well, I think it really does need to consider housing. It also needs to consider consumer sentiment, which has also been fairly low. And let's realize that the Fed is aiming at a target that's on the other side of the horizon. So it really has to make decisions today that are likely to affect the economy 12 to 18 months down the road. So they don't want to allow the economy to move along, employment to loosen more dramatically over time without doing anything at all. So I believe that they feel that they need to cut rates. We think they'll do it in September, skip October, do it again in December, basically just feeling as if they're adding a little bit of stimulus while at the same time not fanning the flames of inflation.
And not just for homes. I mean, Home Depot and Lowe's are reporting this week. You've got Target, TJX, Walmart, everyone but Walmart are expected to show year-over-year declines. How much is tariff still top of mind for you?
Well, that's still an issue. It does not appear that it's likely to be repealed, but it's just been delayed. So the real question is, what kind of weakness will we be seeing in GDP growth in the third quarter, the fourth quarter? Our belief is we're going to go from a 2% year-on-year rise to an annualized number that's 1.8, 1.9% before moving back up to that 2% level in 2026. So we do expect some sort of softness from tariffs. We do expect to see some stickiness in inflation, but as has been said many times, on a year-over-year basis this time next year, that will end up going away.